Welcome to the Fintech One-on-One podcast. This is Peter Renton, Chairman and co-founder of Fintech Nexus. I've been doing these shows since 2013, which makes this the longest running one-on-one interview show in all of Fintech. Thank you for joining me on this journey. If you like this podcast, you should check out our sister shows, Pitch It, the Fintech Startups podcast with Todd Anderson, and Fintech Coffee Break with Isabel Castro. Or you can listen to everything we produce by subscribing to the Fintech Nexus podcast channel. Welcome to the podcast, Mike.
Great to be here, Peter.
Okay, well, let's kick it off by giving the listeners a little bit of background about yourself. I know you've been doing SigFig for a long time, but tell us a little bit about sort of the arc of your career before that.
Sure. I grew up on the East Coast. My parents were first-generation immigrants, and after having a bunch of fun jobs at real companies, they eventually decided to start their own company. So I grew up in a kind of an entrepreneurial household, and they started a small business together. And then I went to school during the dot-com boom. And what was interesting about that, and how it actually kind of connects to SigFig, is the first stock market boom, people were day trading from their dorm rooms. It feels like, kind of like what it felt like, to 2021, when people are on Robinhood. But, I think that was really kind of a early era for, individual investors, trading stocks, right? It was like the first stock market boom post the internet. And then the other thing is, obviously people were starting companies, right? Like everyone and their brother, wanted to start a startup from their dorm rooms. And, I think between all those things coming together, plus the fact that, my mom has been really kind of a lifelong, passionate, self-directed investor, all of that kind of eventually led to, starting SigFig. And, before SigFig, it was interesting. My first job out of school was at Amazon. It's just a wonderful company. It's obviously gone on to grow quite a bit from the era when I was there. But I think at its roots, the most important things I probably took away from Amazon was just like ultimate and utter obsession around customers, right? Like, how do you build things that make customers happy? And that has always been part of like the Amazon way of thinking is, what's the opportunity that we have to disrupt things for the betterment of the customer. And then the other thing is, at some level, just it sounds so obvious in 2022, but just the sheer and ultimate power of technology,
Right.
And really, when you think about Amazon compared to many other e-commerce companies, I think the vast majority of e-commerce companies think of themselves as retailers, whereas Amazon always thought of itself as a software company. And that's a big difference, even though it sounds subtle. And I think it explains a lot of how they think about the world. And given that, I had my early career experiences, a lot of times, people's early career experiences kind of imprint on them, like a perspective on the world. And, I think that ended up, kind of coming back to, again, be kind of related to how SigFig eventually got off the ground.
Right. Well, let's just dig into that for a little bit, because can you just tell us the founding story? And I know it wasn't called SigFig initially, but just tell us sort of the early days there, how you came up with the idea and what it was like when you launched.
Yeah. So the first product we built was called WickInvest. And it was really a wiki for investing. So if you remember, kind of the mid 2000s, this little site that started to get big called Wikipedia, was pretty interesting. At the very early days, people were like, can you really trust what's on Wikipedia? Like you can't trust that. Like random people on the internet write stuff on Wikipedia. And I think, over time it became pretty evident that like the power of the platform and community collaboration and group editing and editorial process, like all that ended up actually creating quite a powerful source of information. And so as we were thinking about, getting, what was then called Wick Invest, but really SigFig off the ground, I think, we've always been united around this idea that, you know, high quality, financial advice has really only been available to people with a lot of money. And with something as transformative as technology and the internet, you have an opportunity to bring good advice to more people, right? And make it more scalable and make it still high quality. And so in the early days, we started with, essentially people like my mom,
Mm.
people where investing is a hobby. And, what's funny is over the years, I think we've come to kind of figure out that for the vast majority of people, investing is actually not a hobby, it's a chore.
Right.
But our first product was really designed for people who enjoy investing. And so we kind of built this thing called Wick Invest. It was think of it as almost like equity research, but done by the crowd, right? Like people could come to the site and, write their analysis of different companies and what's interesting about their business model and the macro forces that are helping it. And, instead of like Goldman Sachs producing equity research, it's like the wisdom of the crowd, right? So
Mhm.
that was the original kind of product concept. And, over the years, I think we've always been, really good at, trying to understand like what are the pain points of our users and is there more that we can do for them? And Wick Invest was always just the beginning, like it wasn't like, we built Wick Invest and then, it didn't work. So we pivoted to something else. I think the concept of the company was always to kind of build like multiple different products, all related to like, this idea of helping people make better financial decisions. And so eventually, what we saw in the user base was for these people who enjoy investing, they actually have their money spread across a lot of accounts. So it's
Mhm.
very common in the US that people have multiple accounts. Some of that is an artifact of, the 401k system and the fact that for every employer you have where you open up 401k, you end up with like more and more and more accounts through your career. And a lot of people, that money is a little bit of sleep at the wheel. They like contributed that money to get the match. They don't really know exactly what kinds of assets are in the account. They're not really paying much attention to it. But these are assets that are like the assets that are going to help you retire one day. And
Right.
if you don't optimally invest that money, you're either not going to make it or you're going to have to work longer, or you're gonna get there slower than you otherwise could if that money were well managed. And basically what happened was we ended up building this portfolio tracking tool.
Mhm.
So, if you remember the early days, there's like a site called Mint, it was like
Oh, yeah. I was a Mint
get your
user.
accounts.
Mint
Yeah, you're a
user in the
Mint
mid
user.
2000s, yeah.
So, the first version of this portfolio tracking tool was a little bit like Mint for investing. Like we didn't focus on like bank accounts and credit card aggregation. We just focused on investments. And we really tried to build a tool that would let you see all of your portfolio in one place. And then one of the fascinating things that happened after that was we started signing partnerships with other companies who wanted better portfolio tracking tools.
Hmm.
And it turns out that the vast majority of people who like, were tracking stocks on the internet at that point were doing them on, what we think of as the traditional finance portals. So Yahoo Finance, CNN Money, AOL Money, sites like that. And they all had like some version of portfolio tracking, but all of them were like really pretty terrible experiences. And so we basically went to those big portals and said, "Hey, we've got this really great portfolio tracking tool. It syncs with all our accounts, beautiful design, makes it really easy. We have real-time quotes, like all these things that, those customers wanted. And we'll offer to kind of power this for you." And so, over the course of a few years, we ended up partnering with, almost all the big major finance portals.
Hmm.
And as you can imagine, part of our thesis was, hey, the more people we can reach, the more people who will use our product. And that turned out to be true. Within a few years, we ended up tracking almost $500 billion worth of assets for across a couple million accounts. And that's kind of the beginning of what happened to SigFig, really, because what happened was we looked at all that data, and we basically found that the vast, vast, vast majority of people who have investments in this country are just asleep at the wheel, making kind of not good decisions or making no decisions at all. And that's eventually what led us to building, this whole like investment management business with, what people call robo-advice. And for us, we really focused on a B2B model. So we kind of partner with third-party institutions.
Right, right. But I'd love to get your sense with, now you've been doing this for a while, even before the financial crisis, and now we've had a crazy, couple of years in the investment markets, and now things are, who knows what the future holds, but been going down for the last at least few months. So what have you found that the average consumer who has investments, which obviously many consumers don't, but those who have investments, are they getting better at investing through your platform and others, or is the behavior still, like they sell at the low point and buy at the high point?
Yeah. So, let's be overly simplistic for a second. I said before, like some people investing as a chore, some people investing as a hobby.
Mm-hmm.
Another way to split the world is essentially people who use investments to save for the long term, and people who are like trying to get rich quick. And again, this is like an oversimplification. But what you find is that people saving for the long term, they're essentially investing because investing is the new way to save. Like our parents' generation, they saved in, CDs and savings accounts, and they had pension plans. Like 40 years ago, people saved for retirement in a very different way than they do today.
Right.
Today, like people are told, save for your own retirement. Like you decide, if you want to open up a 401k, you decide how much to contribute to it. Maybe your employer will like incentivize you by matching a little bit. And then once you put your money in your 401k, you got to manage it yourself, right? Like no one's going to manage it for you like a pension plan.
Mm-hmm.
And so, that's part of why the investment industry has grown so much in the last few decades, because all of that long-term wealth accumulation that happens in the world now, most of it ends up in some sort of investment vehicle, right? And so, that customer base, what's important to them? They want to save for those long-term goals. They need to make regular contributions over time. They need that money to not be like, 100% in Tesla stock or, GameStop or, whatever happened during the pandemic. They need it to be in a healthy, diversified portfolio with an appropriate amount of risk. They want it to be, at some sense, they want to take the burden and the fear of doing that well off. They want to like find someone to help them do it. And that's why the vast majority of assets that are managed in this country and in the world are advised, right? Like there's someone who's a professional helping people do that. And, that's kind of one big bucket. And then the other bucket is people who are like DIY, do it myself. I'm going to day trade. I'm going to try to beat the markets. I'm going to get those stock tips. I'm gonna be able to brag to my friends about how I picked the right stock and it did well. And that's a very different persona. Right. And what you actually find is sometimes one consumer is both personas.
Mm-hmm.
They take 80 or 90% of their portfolio, they have someone else manage it so it's done right, and then they keep 10 or 20% as like play money, and it's not uncommon that you kind of see both. But the behavior patterns of money in each bucket are really different. So the kind of play money, self-directed investor trying to pick stocks, what you find is that retail investor interest in that segment is very cyclical. It comes and it goes, it comes and it goes. In 1999, it comes. There was lots of people, like I said at the beginning, like when I went to college, like lots of students were like trying to, buy a few stocks on the side. Obviously, like markets crashed in 01, right? Then retail interest really pulled back. Then you had again kind of a somewhat of a stable and up market for a few years, and then in 08, 09 it crashed again, right? And people pulled back, and then what did we see in the last 3 or 4 years, right? Like continued interest, continued interest. You saw the whole Robinhood boom. And then when the market crashed, again, kind of big pullback. And so that kind of retail investor, I think they're really subject to the kind of the whims of the market and like what's happening in the markets. Whereas the long-term retirement savings investor, they keep saving, right?
Right.
Like and so I think because our product is positioned more for that market segment than people who want to like day trade stocks, we've actually seen very steady growth over the years. We
Right.
haven't seen, we haven't got the benefit of the ups, but we definitely haven't seen the downside of the downs. And so, I think we definitely see steady behavior, and I think we are helping people invest better. We're helping them get diversified. We're helping them get into portfolios that are appropriate for them.
Mhm.
We're helping them save on fees and taxes, and those are probably good things in up markets and down markets.
Yep. Yep. The whole like dollar cost averaging. I try and instill in my kids. I got teenagers who are starting to have a little bit of money from their jobs they're doing, and yeah, I see you got a dollar cost average your way.
Did you say
Or
a crypto cost average?
dollar cost average. But if you are going into crypto, you should be doing that as well, really.
Right.
Averaging your, buying a little bit at a time. But anyway, we digress. I want to talk about another really big piece of finance that's starting to get talked about is this wealth transfer that you've got baby boomers that are aging and dying, and you've got millennials that are inheriting. There's going to be tens of trillions of dollars, I've read, of inherited wealth that's going to be it's going to kind of come down from the baby boomers. So how do you view that at SigFig? And I mean, I imagine it's a massive opportunity, right?
Yeah, that trend is absolutely real. You've seen study after study after study citing the scale of the order of magnitude of what's happening there. I think that's actually a big reason why all the big firms are taking digital transformation so seriously. I
Mm-hmm.
think they know they have these large incumbent legacy wealth management businesses. They're healthy, they generate a lot of cash flow, they're not disappearing overnight. But one of the big threats is like if retail behavior changes, and if the last generation preferred to work with a human advisor and the next generation prefers to have great mobile experiences that maybe have advisors and maybe don't, you do need to kind of prepare for the future in advance. You can't wake up in 25 years saying, oh wow, $20 trillion moved and like now we should get going, right? Because all those clients have picked their ways and their providers at that point. And so, you look up and down Wall Street. I mean, literally, like, I don't know a single kind of large bank that hasn't increased its focus and, investments into the wealth management and investment industry. Like
Mm-hmm.
every single bank, I think, sees wealth as a critical part of financial services. They see the steady long-term revenues that can be created. They see that the clients have that need that, in a lot of cases is actually underserved because, traditional wealth managers have focused on only the top, 5 or 10% of the population.
Mm-hmm.
And they see an opportunity, right? Like, especially the retail banks who already have the customers, they're looking at that customer base saying, hey, we've got an install base who's been with us for 10, 20, 30 years. They have their bank account with us. They have their credit card sometimes with us, but they don't always have their investment accounts with us. And we can offer a better value prop with a better client experience than what they're seeing out there in the world. And I think that's why all the big banks are kind of leaning into wealth management and making it a bigger part of their business model.
Right, makes sense. So, and you're working with a lot of these, large organizations. Maybe can you tell us some of the names that you can publicly share of the companies you're working with, and maybe describe a little bit of the detail about what you're actually providing?
Yeah, absolutely. So, yeah, we work with firms large and small. They tend to fall into two buckets. One is what we think of as retail banks. Banks where maybe the core offering is like a checking account or some sort of retail offering. And then wealth management firms where their core offering is wealth and investment management. Those are the two kind of big sectors. Some of the bigger clients we serve, Wells Fargo, UBS, Scotiabank up in Canada. We also serve a lot of mid-sized firms, so like Santander Bank, Citizens Bank, and then we also work with some small financial institutions as well. So we kind of run the gamut in those two verticals. To your question of like what do we do for them? It's just been a fascinating evolution over the last few years. Our brand in the industry is better known for like the investment stuff that we do. And we've actually expanded quite a bit from there. So in the early days, we really focused on that, like, what the industry likes to call the robo-advisor opportunity. But what actually we quickly figured out is that by using much more modern software that's actually designed with the client and the advisor experience in mind, that technology can be used by traditional financial advisors. And I think there was a real misconception in the early days of quote unquote robo-advice that the robo-advisors were out to like put the advisors out of business, right? And it was a competition. Is it man or machine? Like which way are you going to go? And actually, what you find is a lot of human advisors, clients, want the benefit of human advice. And a lot of advisors want the benefit of better technology.
Right.
And so, what we kind of quickly figured out is like, we should be able to adapt our platform for use by advisors who work with clients. And so we built kind of a variant of our product called Digital Advisor Pro that really is designed to help, make advisors more bionic, like put better technology in their hands so that they can spend more time with clients and less time rebalancing portfolios and managing paperwork and, doing all the stuff that they kind of do manually in the world today.
So it's like like having the software rebalance and like, it's almost like a robo-advisor type functionality, but for the actual human advisor.
Yeah, and what the industry, used to and still even to this day calls these platforms are essentially TAMPs, turnkey asset management programs. And the early TAMPs focused around asset management. Literally it's like the software that balances the portfolio. They didn't really have tax loss harvesting in the early days of TAMPs, but since then, there's tax optimization logic and stuff like that. But what's really fascinating is, sometimes people ask us, are we a TAMP? And, what people think of as TAMPs are basically just investment management software. And what we think is actually quite different about SigFig is when you really ask a consumer, why do you hire a financial advisor to help you? They're hiring them for more than portfolio management. Portfolio management is commoditized. Like if you want to just portfolio management, I mean, there's a lot of places in the world you can kind of go to get portfolio management help. People hire advisors for help with financial planning, trust and estates. They hire them for peace of mind. They hire them to have someone to call, to ask questions. They hire them for all these different reasons. And the TAMP software category doesn't do any of those other things. All they do is manage portfolios. And so what we found with the early platform we built was by combining financial planning with investment management, with account opening, with the digital experience on mobile and web, with the advisor collaboration tools that you would use to facilitate an interaction between a client and an advisor. Like there are all these different components of having like a modern wealth management offering. And we ended up kind of building this integrated suite that really kind of ties all those pieces together. And that leads to a client experience that makes a lot more sense and operations that are a lot more efficient. And the operations being efficient are actually really important in the long term. Why? one, every cost that a bank has to manage a client basically has to get translated in a higher fee structure, right? So the more inefficient the business is, the higher the fee, you have to charge your clients. And two, it's about democratization, right? Like if you have a very inefficient business model and you make money on AUM, then you're going to tend to really only be able to serve wealthy clients.
Right.
Whereas if you can get to a lot more efficient operations, you actually can serve a lot more clients in a profitable way. And so all of that kind of comes together in this kind of platform we built so that we can lead to better client experience, better advisor experience, much more efficiency for the business, and we hope that that leads to better returns for the client, lower fees for the client, and maybe even increased profitability for the bank and the advisor. So you can kind of get the benefit of all sides. So anyways, kind of for a few years, we kind of expanded what we do in investments. And then over the last couple of years, we expanded beyond investments. So we ended up building a couple new product lines that are basically aligned around two basic themes. One is how do we broaden the kind of advice that we give to clients? So instead of thinking about it as just investment advice, like a lot of the banks that we work with, they offer more than investment services, right? They offer lending products, they offer, the deposit products, they offer sometimes insurance products. And clients don't think about their finances in the silos that the industry has put these products in, right? They think of that from the perspective of buying a home or saving for retirement or protecting the interests of my family. And when you do those things, you might be using a savings account, you might be using an investment account, you might be using a mortgage. But what we ended up saying was, how do we give kind of holistic, integrated advice? How do we understand the broader needs that a consumer has? And how do we build digital experiences that can kind of learn what those needs are and then recommend the right products, the right actions, the right service providers to kind of satisfy those needs?
Right.
And then most recently during the pandemic, we built a brand new product called Engage that actually facilitates virtual collaboration with clients. So, this is a topic we've been studying for a long time. The pandemic was kind of a perfect accelerant of, this basic concept. And, when the pandemic hit us and, we're all disrupted, I think, that is just a interesting moment for creating new things. And we basically said, well, all these other industries that have seemed to go virtual, whether it's working with coworkers over Zoom or meeting with your doctor over a telehealth appointment, or maybe even some of the distance learning that students and teachers had to, interact with, during the pandemic. There are verticals where like in-person collaboration is clearly superior. Like I think most people would say in-person teaching is better than, kind of virtual, education. But finance is actually a very, very well suited vertical for virtual collaboration. And most banks have not made it easy to collaborate virtually. So we kind of ended up building this product that is designed to help enable and facilitate like a immersive interactive experience, even if you're not face-to-face, sitting in a branch with a banker.
Yeah, and I imagine even now that we're back to in-person, it's probably staying as a popular product because it's just it's more efficient. People are not working. You don't have to work. You don't have to come into your office, and I imagine that's great. But anyway, I want to move on because a couple more things I really want to get to here. And one is, you mentioned UBS. You're working with them, and we had the sort of the possible, or was announced that UBS was going to acquire Wealthfront, and then they broke up, and that didn't happen. Obviously, you obviously know Wealthfront, UBS. I'd love to get your perspective on this particular episode that happened this year.
Yeah, I don't know that there's kind of a big, fancy, juicy story behind it. I think, when I think about our sector, I'm a huge fan of, other companies using software to help digitize. This is a massive opportunity that's going to take a lot of different smart people kind of working on it to kind of unlock the real potential of it. I think, when you think about, what's happened in the industry, that thing I said earlier about digital becoming more important, I mean, that's almost like an obvious statement that, if you walked into any boardroom at any bank, that would be true, right? Like every bank in the world that I know of is placing more and more emphasis on the importance of digital and software and all that stuff.
Mhm.
So for a ton of reasons, Wealthfront's a great company, UBS is a great company. There's a lot of things that, they could do together. Why did it fall apart? I don't really want to speculate. But I think, when you think about, the reasons that, a firm would, consider an acquisition like that, I think, it's obvious, like digital is becoming such an important part of the future of most businesses. And, for a lot of banks, the internal focus, talent, and culture is not really around software, right? Like many banks are really strong at sales and distribution. Some banks are strong at marketing and product. And, banks spend a lot of money on software. They have a lot of people who work on software. But a lot of the technology that banks operate internally is like infrastructure software. So
Mhm.
it's core systems, trading systems, core banking data, massive data repositories. And, I think part of where SigFig has chosen to focus is really around customer experience software. That software that you use to actually offer the offering you do to your clients, to the software you use to facilitate collaboration between, an advisor and a client. And that client experience software actually really requires not just great software acumen, but really amazing design work, product work, all of the like consumer internet DNA of like building things beautifully and things that feel easy to use. That DNA has not really made its way into enterprise software. And so, we just see a huge opportunity to make, the experience that, a client and a provider, have using software just feel much more modern, much more cloud-based, and, much more dynamic. And that's kind of turned out to be, kind of where our sweet spot has been.
Right, and you're really focused on the business to business side of this. I'd love to get your perspective on the direct to consumer, the robo advice. Although they're not really most of the robo advisors now have a broad suite of products, not just focusing on that one piece. But are you bullish about these direct to retail, companies that focus on wealth management as a core? I mean, feels like they've been around a long time. It hasn't, I would have expected by now some of these companies would have tremendous scale, but some of them have decent scale, but they're not even coming close to the Vanguards, Charles Schwab's, and BlackRocks of the world, right?
Yeah. Yeah, I would say I'm modestly bullish. I think the winds are blowing in the right direction around democratization, lower fees, better products, more digitalization, like all of that, all the reasons that we've seen such growth in our business, I think absolutely help the kind of B2C players. I think I'm modestly bullish because, part of why we chose B2B is, the wealth management industry is an industry that's very diverse with a lot of players, and, no one firm has like massive market share. I mean, it's just too big of a pie, to have, one or two or three players kind of eat it all. And so, part of why, I think we chose the B2B path is because we looked at that market. We said, look at how large it is. How big are we likely to get going direct to consumer versus how big are we likely to get if we actually build the technology, but then put it in the hands of incumbent players? And our assessment was like, we would be able to make a lot more progress on our mission of helping people get to a better place by being the provider of technology to other firms, right? And I think if you couple that observation with the fact that, most banks are not software companies, that's not their DNA, it's not their history, it's not their legacy. They have some talent pool there, but it's not usually the majority of the, the talent inside of a bank. And so for all those reasons, we just felt like there's like perfect synergy. They bring a customer base, a brand, they bring trust in that brand, they bring assets. We bring, the product and the technology, the design, expertise, and that ends up being, a marriage made in heaven, right? Like we each bring, assets to that partnership that, the other party doesn't have, and that makes both sides better off as a result. So, obviously, I think we're more bullish on the B2B approach because, we think we can kind of reach a lot more people and get to a lot more scale. But I'm not bearish on the B2C approach either. I think you're seeing some nice franchises getting built. And, one of the beauties of the investment industry is, slow and steady wins the race. Vanguard didn't get to however many trillion dollars they are overnight. It was a 50 years of annual compounded growth over and over and over and over and over again that got them to where they are today. So I don't think it's reasonable to expect that, a new B2C player in in 5 years is going to become, $1 trillion platform. Like, I don't know a single financial institution that got to $1 trillion that quickly. So I think it just takes time. And, I hope they're successful because their success will accelerate our success.
Right. Okay, then. So last question. I mean, as we look to 2023, what's on tap for SigFig? What's next?
Great question. Well, I think there's a couple basic themes. I touched a little bit on this concept of of virtual collaboration. And one of the interesting things that we have seen is that virtual collaboration is a big use case for that product. But part of what was kind of well received by the industry from what we built is actually this idea that once you're using software to facilitate a client interaction, the people who run the firm actually can start to influence what the software does. And so what's powerful about that is it allows a bank to have a much more systematic way of interacting with their customers. And I think of this as like, if you think about the world of in-person collaboration, let's say you're a client, you walk into a bank, you sit down and talk to a banker. 99% of that interaction is verbal. You sit at a desk and you talk to each other. And so there's not actually a lot of opportunity in the kind of prior era to use software in that interaction. When the in-person interaction goes virtual, suddenly, a screen is between the client and the provider. And that screen is a very powerful communication tool. It's a very powerful collaboration tool. It's a very powerful workplace and productivity tool. And yet, most banks have not been built around, interactive collaborative workflow. They have not been built around screen-based collaboration. And so what happened with Engage is because we built this platform that was focused initially on virtual collaboration, we ended up finding all kinds of interesting ways to unlock the power of the screen. Right. And that screen is good communication tool. You can do financial planning, you can sign documents, you can aggregate your data, you can do all kinds of stuff when the interaction is more than just a verbal conversation. And what we're finding now is that concept of screen-based collaboration and having like a platform that actually facilitates more effective client interactions, that actually can also be used in the analog world. And it's almost coming full circle. So, if you walk into a bank branch in a few years, maybe you're not just sitting at a desk talking with a banker. Maybe you're actually looking at an iPad together. Maybe you have a screen that you're using to kind of work with the banker. I think that actually will unlock like a much more effective, experience for the client and the banker. And so, that's kind of one, big theme that, we're passionate about and, putting a lot of, R&D dollars into. We're also seeing, kind of the spillover of banks wanting to actually expand their advice offerings. So if you look at the typical bank, most of the bank sales and marketing is what I would call product selling.
Mm.
You think about all the direct mail that you get from banks, right? Like, what are they doing in that direct mail? They're selling you product, right? They're selling you a checking account, they're selling you a credit card, they're selling you a mortgage. And how do you compete on product? Rates and fees, essentially. It's super commoditized. Most of the smart banks that we know and talk to, they're really trying to adapt their offering to be about more than just selling product. They want to be offering advice, they want to be offering solutions, they want to be more client-led, client-centric. And again, like, that's a huge opportunity for software to help accelerate that transition. Right? It's actually kind of hard for the typical retail banker to serve a client really well. If you're a retail banker, you're probably somewhat early in your career. You probably weren't like CFA or PhD in finance. It's a professional job, but it's not the most kind of high skilled workforce. But they're earnest in wanting to help clients, right? Like, a lot of bankers that I know, they're there to help serve clients. They're frontline service and sales professionals. And so, where does software come into play? If you can use software to help assist a banker give better advice, more personal advice, more compliant advice, help the banker say the right things, not say the wrong things, you're going to have a banker workforce that's more effective, right? And that's going to be a real opportunity for the world, because, like, let me tell you, there's a huge shortage of financial advice. Most people never learn financial advice in school. They never learn, financial advice, in some sort of formal setting. Actually, most people learn financial behaviors from their parents.
Right.
And some parents have good financial behaviors, some parents don't have good financial behaviors. And so there's a real gap of, where does the world turn to for financial advice? And I hope that software is going to be a big part of that answer. We're going to get to a better place for everybody involved if we can take advantage of how powerful software is to give good advice.
Indeed. Well, I think that's a great place to end it, Mike. Thank you so much for coming on the show. It's exciting what you guys are doing, and I think, as you say, there's a lot more to be done here. And anyway, appreciate you coming on the show.
Awesome, my pleasure, and it was nice chatting with you.
Okay, see ya.
Bye.